Right now, dedicated electric vehicle divisions at major Western automakers are bleeding billions of dollars in operating losses. Yet their overall corporate earnings are being completely shielded by a 20-year-old technology, the hybrid.
Right.
In the United States, hybrid vehicles have methodically climbed to, roughly, 1 in 6 new light vehicle sales, and over that same period, full battery electric market share remains materially lower.
And that persistent gap, between electric aspirations and hybrid reality, it is actively changing factory production plans. It is rewriting long-term supplier contracts and, well, it's dictating exactly where corporate boards choose to send the next $1 billion of capital.
You can track these exact corporate shifts in the public filings this quarter. Toyota, for instance, is expanding hybrid production across several of its American manufacturing plants. They are allocating capital to proven internal combustion architectures.
While Honda is strategically restructuring its electric rollout to lean significantly harder on immediate hybrid demand.
Correct. And Ford is narrowing its forward EV ambitions as its highly profitable truck, commercial, and hybrid businesses carry the weight of the corporate balance sheet. So for you, sitting in on this briefing as an institutional investor, the hybrid has become the product that keeps the electric future financeable.
I would push back on that framing slightly.
Go ahead.
Well, hybrids are undeniably generating cash in the present quarter. However, the premise that they keep the electric future financeable is highly conditional. That assertion is valid only if the cash generated actually builds that electric future, rather than just, postponing it.
Understood. To properly evaluate how hybrids finance a transition, the analysis really must move from top-line revenue down to factory floor unit economics. If you're assessing these balance sheets, you cannot just look at sales volume.
No, you can't.
The mechanical differences between these powertrains dictate the exact capital requirements.
Yeah.
A battery electric vehicle completely replaces the internal combustion engine.
Right, the transmission, the exhaust, the fuel system, all of it.
Exactly. It swaps them for a large battery pack, electric motors, power electronics, thermal controls, and complex software. While the mechanical architecture is technically simpler, the battery itself remains a massive capital expense.
Furthermore, the factory transition for a pure electric vehicle often requires completely new production tooling. You're talking about entirely new supplier ecosystems and revamped quality systems. A conventional hybrid, on the other hand, retains the combustion engine but adds a smaller battery, an electric motor, regenerative braking, and the associated control electronics.
And from a capital expenditure perspective, that is the critical distinction. A hybrid can seamlessly share an existing vehicle platform. It utilizes the current assembly line, relies on the legacy dealer network, and, frankly, draws from the established supplier base.
Which brings us to the supply chain.
Right. How exactly does that shared platform dynamic alter the financial survival math for a legacy automaker?
Well, that overlap is critical because auto manufacturing is, at its core, a heavily fixed cost business. A manufacturing plant does not stop depreciating simply because consumer demand misses a forward forecast. Stamping presses, paint shops, robotics, and negotiated labor contracts, they continue consuming cash regardless of volume.
To put it in perspective, an automotive plant operates much like a municipal power grid. The physical infrastructure incurs massive depreciation costs, whether you push 1 unit of energy through the system or 1 million. That depreciation consumes cash no matter what.
That's the reality of it. Every single vehicle produced must cover its raw materials, warranty provisions, logistics, and a calculated portion of that massive industrial base before it ever contributes to earnings before interest and taxes. When an EV line runs below capacity, the fixed cost burden per vehicle destroys the operating margin.
Let us examine the specific crossover margin math that drives this dynamic. Consider a standard crossover vehicle on the market today. The integrated hybrid hardware adds roughly $2,500 to total production costs.
Right.
However, the manufacturer typically commands a, $3,500 premium over the comparable gasoline version.
That equation leaves exactly $1,000 of incremental gross profit before accounting for overhead and marketing.
But that specific margin math effectively shields near-term profitability. It keeps mature factories, legacy suppliers, dealers, and captive finance operations fully productive, while the EV programs absorb the heavy capex drain.
I push back firmly on the concept of this being a complete rescue, though.
Why is that?
Attempting to run combustion, Full hybrid, plug-in hybrid, and battery electric assembly lines simultaneously creates massive systemic friction. It severely spikes validation expenses, dramatically increases working capital requirements, and expands long-term warranty exposure.
So if they are making a $1,000 premium on these hybrids, why does running those lines concurrently create so much friction?
Because corporate capital remains strictly finite. Attempting to build combustion, hybrid, and EV lines simultaneously is the industrial equivalent of trying to gut and remodel a commercial manufacturing facility while simultaneously hitting peak quarterly production targets.
Sure.
The operational friction is immense. Any capital spent updating legacy engines, hybrid transmissions, and thermal systems is capital explicitly not spent scaling battery cell production, centralized computing, or next-generation electric platforms.
The bullish case presented by management teams is that buyers immediately save on fuel consumption without changing their driving habits,
Yeah.
thereby giving automakers essential time. Time to methodically reduce EV component costs, improve vehicle software, and wait for public charging infrastructure to materialize.
They are essentially arguing that the industry made a fundamental sequencing error.
Correct. By building massive EV capacity years before mainstream customers were ready, management destroyed returns on invested capital. Under this thesis, a profitable hybrid is not ideological hesitation. It is a calculated funding mechanism.
The overarching risk is that a funding mechanism easily becomes a permanent excuse. Management teams may choose to utilize this influx of hybrid cash to protect near-term earnings, artificially increase dividends, or execute share repurchases. In doing so, they borrow competitiveness from the future.
They risk discovering too late that rival manufacturers use the exact same period to build significantly cheaper batteries, highly integrated software, and more flexible platforms.
The core issue is not whether hybrids make money today. It is entirely about what happens to that money. If hybrid cash finances battery chemistry and software-defined architectures, the strategy is highly rational. If it merely extends old tooling, the company is failing the transition.
The implications of earning that $1,000 margin create significant ripples upstream as well. In the battery supply chain, the gigawatt-hour math is decisive. Let us quantify the scale here. 1 gigawatt-hour of cell production can support significantly more conventional hybrids than long-range EVs, simply because the individual battery pack is fractionally smaller.
To illustrate that, consider a single, massive 80 kilowatt-hour battery pack designed for one long-range electric vehicle. If you take that exact same battery capacity and divide it into smaller 1.5 kilowatt-hour packs, you can power upwards of 50 conventional hybrids.
50 to 1.
Yes, you are effectively leveraging the same finite supply of raw materials to secure 50 individual retail sales instead of just one.
This dynamic drastically reduces the near-term demand curve for raw materials like lithium, nickel, and graphite.
For macro analysts tracking raw materials, this shifts the transition risk directly upstream. It places severe pressure on mining projects that secured financing based on highly aggressive EV volume assumptions.
Right.
Furthermore, it leaves cell manufacturers grappling with lower factory utilization rates and delayed expansions. Their unit economics require selling maximum kilowatt hours per vehicle.
So what happens to the suppliers who committed entirely to the electric transition?
Binary bet suppliers, those who assumed combustion was completely dead and reallocated all their tooling to electric components, are exceptionally vulnerable today. A supply chain built on aggressive EV forecasts is like a highly leveraged bridge loan. It only survives if the terminal transaction closes on time.
When EV volumes miss expectations, these binary bet suppliers face immediate liquidity crises.
Exactly. Whereas traditional thermal and engine suppliers have suddenly been granted a much longer operational runway.
But that $1,000 profit margin does not just stay at the factory level. It fundamentally alters the survival math for the people actually selling the cars, the local dealers. Shifting downstream to the retail network, the economics also heavily favor the hybrid.
Faster vehicle turnover reduces floor plan interest.
For you as an institutional investor assessing these localized networks, floor plan interest is essentially the ticking clock of financing costs that dealers pay for every single day a vehicle sits unsold on their lot. This metric is absolutely crucial for dealer survival in high-rate environments.
A hybrid vehicle selling in 10 days incurs drastically lower carrying costs than a premium EV sitting for 120 days. Faster turnover mitigates that cost.
Furthermore, hybrids actively protect captive finance companies by generating better residual values. A profitable retail sale can be undone quarters later if the finance arm is forced to take a massive residual value loss when a heavily depreciated lease vehicle returns to the balance sheet.
Hybrids also preserve ongoing service revenue from internal combustion engines, complex cooling systems, and mechanical transmissions. This gives dealers a strong, localized economic incentive to support the product over an EV, which, requires significantly less routine maintenance.
We must also factor in the macro grid effect.
Conventional hybrids give municipal utilities critical time to adequately upgrade local substations, transformers, and public networks as they add zero charging load to the grid.
Plug-in hybrids sit squarely between these two infrastructure realities. If utilized properly by consumers, plug-ins cover daily travel on grid electricity and retain the combustion engine for long-distance travel.
Used poorly, though, they simply carry the dead weight of two distinct powertrains while delivering negligible, real-world emissions benefits. You can expect governments to eventually tie regulatory incentives strictly to verified electric miles driven. The oil system, including refineries and maintenance networks, remains highly relevant in this intermediate phase.
Dealership economics are distinctly local, but supply chains are unavoidably global. This forces automakers to navigate highly fragmented geopolitical realities.
This fragmentation requires complex global portfolio hedging. A single manufacturer must deploy full hybrids in the U.S. market to satisfy current demand, highly efficient conventional hybrids in emerging markets that lack grid infrastructure, plug-in systems in Europe to meet strict regulatory emissions mandates, and hyper-competitive battery electric vehicles in China to compete with domestic manufacturers.
It is a hedge against localized regulation, infrastructure maturity, and currency risk.
However, flexibility carries a heavy carrying cost. Maintaining multiple vehicle architectures perpetually drains engineering budgets and working capital.
Western trade barriers and tariffs currently provide legacy manufacturers with additional time against low-cost imported EVs. This allows them to protect domestic pricing while local battery plants slowly ramp production.
Regulatory protection can preserve cash flow, sure, but it equally preserves high systemic operational costs. Chinese manufacturers continue aggressively improving their battery economics and extended range platforms. Time does not automatically confer competitiveness.
This landscape introduces a definitive new capital market test for assessing these balance sheets, the concept of CapEx reversibility.
For you sitting in on this briefing, the true winner is the enterprise whose physical assets, shared software architectures, adaptable electric motors, and flexible body shops remain fully productive, even if initial consumer demand forecasts are completely wrong.
That is the crucial metric. Flexible manufacturing plants drastically reduce the risk of stranded depreciation.
We synthesize this entire dynamic into 5 specific institutional metrics you must track to evaluate these equities. Number 1, hybrid contribution margin per vehicle. Number 2, absolute factory utilization rates. Number 3, the precise EV cash loss. Number 4, regulatory compliance cost. And number 5, the exact share of capital expenditure that is fully reusable across disparate powertrains.
In a clinical summary of this strategic landscape, the probable winners are those legacy manufacturers with proven hybrid systems, highly adaptable factories, and disciplined pricing power. The absolute greatest corporate risk sits with automakers attempting to fund two distinct industrial systems while leading neither. Accounting profit on the income statement must successfully translate to durable free cash flow.
It culminates in the ultimate strategic test. If a hybrid vehicle successfully extends the old business while simultaneously financing the new one, it can restore profitability without halting electrification. However, if a hybrid solely extends the legacy business, the industry is not solving its fundamental transition problem. It is merely refinancing the delay.
Subscribe to the Unlayered Global and share this with someone who still thinks the auto race is simply gasoline versus electric. The real contest is between companies that can fund the future and companies that run out of cash before it arrives.